Assalamu alaikum. Welcome to the last lecture of tax. So this is the last tax that we are going to do, that is value added tax, VAT. This is the only tax that is indirect out of the 5 tax that we have covered till now. Income tax, capital gain tax, inheritance tax, corporation tax are all direct tax. So income tax is the tax on the income, capital gain tax is the tax on any gain that you make. For example, if you are selling or gifting capital assets. Inheritance tax is the transfer of wealth, the tax on the transfer of wealth. That was the previous lecture that I've covered, lecture 21 on inheritance. And then corporation tax is the tax on the company profit. Now we are moving on to the last tax, that is VAT. This is the indirect tax. So here we are going to go through the scope of VAT. What is the concept? What is the definition of VAT? What is the meaning of taxable supply, exempt supply, supplies outside the scope? Then zero rated supply, taxable person. Then we are going to go through when to register, when to deregister. Okay, what is compulsory registration, late registration, voluntary registration, and when are you exempted from registration and deregistration? When you transfer the business as a going concern, what is the impact on VAT? Then there's a group VAT registration. When you're in a group, you can register for group VAT. Okay, what is the effect of the group registration, advantages of group registration? Then recovery of input VAT. Input VAT is the VAT that you pay on your purchases. So what is irrecoverable input VAT? Irrecoverable input VAT means which you cannot recover, which you cannot reclaim from HMRC. Pre-registration expenditure. Any expenditure you have incurred before you register for VAT. Output VAT. Output VAT is the VAT that you charge on your supply, that you receive from your customers. Input VAT is something that you pay to your supplier. So place of supply matters a lot for output VAT. What is the tax value? What is the time of supply? The tax point. Gift of goods and services. Car expenses and fuel for private use. Impairment losses. Then we are moving on to VAT on exports and imports. So when you're exporting and importing outside UK, the export of goods and services outside UK and import of goods and services from outside UK, and post-point accounting. Then importing of services from outside the UK, international services. These 3 we are going to cover. Then VAT accounting. There are VAT, see, income tax, capital gain tax, inheritance tax follows the tax year. On the tax year we tax, except corporation tax. Corporation tax is on accounting period. Okay, VAT follows tax period, VAT period. There's a VAT period. Okay. So what are the records one has to keep for VAT? Then the tax invoices, credit notes, VAT returns, error, late filing submission penalty. In this, we are going to cover the administration part of VAT also. Okay, this lecture has every aspect of VAT that you need for VAT. Then late payment of penalties, late payment interest. See, all these things, late payment, penalty, interest, we have covered for other types of tax also. Income tax, capital gain tax, inheritance tax, corporation tax. Same for VAT also. Then what is the reasonable excuse? Then payment by large businesses. Then if a small business, for small businesses there are schemes: annual accounting, cash accounting, flat rate accounting, which is available for small businesses. We are going to go through the similarities and the difference between these 3 schemes. Okay, in your tax exam you might be tested on one of the schemes. Then finally we are going to conclude which syllabus did we touch, then summarize the entire lecture and which technical articles you have to read based on this lecture. So starting with scope: registration, group registration, recovery of input tax, output VAT, exports imports, the administrative part of VAT, then the 3 schemes. So these are the 7 areas we are going to cover in this lecture. Starting with the concept. Okay, so VAT is a consumer expenditure tax. Okay, and this is collected at each stage in your supply chain by the businesses. So this VAT will be added to your sales proceed at each stage, known as output VAT. Okay, and input VAT is that you pay to your supplier when you make the purchases. Okay, remember, so you keep on adding like that until the output VAT is finally borne by the final consumer, who is then unable to recover this tax paid because he did not, he cannot keep on adding. No, he's the last one in the chain. So it's your output VAT minus input VAT. That is the amount on which you have to pay VAT. Add all your output VAT, deduct all your input VAT. Okay, the standard VAT rate is 20%. There is no other percentage, is 20%. Then VAT is an indirect tax administered by HMRC. Now example 1. So here let us go through example 1, where you can see the price is 80. Okay, but with this 80 they're adding VAT 20%. So if 20% of 80 is 16, so your final price will be 96. When it is sold to the car dealer, it is 96. Next is the same here. So this is the car dealer holds component in inventory until sale to private customer. So here also they will add 20% VAT on that 120. Final price is 144. So what happened? From your output VAT that is on sale, you deduct your input VAT that is on purchase. So your output VAT here you see from 144 to 120. It is 24. This is your output VAT. With this you deduct 16. So this is the VAT that you have to pay to HMRC, 8. Okay. And the customer will pay 144. It has VAT in it. Okay, he will pay 144 only, the final customer. Now, definition of VAT. So a taxable person is someone who is registered or ought to be registered for VAT. This will be further explained in section 1.7. VAT is charged on a taxable supply of goods and services. It has to be taxable. If it's not taxable, you can't charge VAT. Okay, made by a taxable person, where the supply is either made in UK or an import into UK from country outside UK. Now, taxable supply. Taxable supply is supply which are not exempt supply, okay, or which is not outside the scope of VAT. Exempt supplies are that which are not taxable. So here you can't add any output VAT, no input VAT. If you incur any input VAT related to exempt supply, you cannot recover them. It cannot be recovered. No input VAT can be recovered. That is the disadvantage of exempt supply. You cannot add output VAT, nor you can reclaim input VAT. Next, outside the scope of VAT. If it's outside the scope of VAT, they are never treated as supply for VAT purpose. This we'll see in section 1.5. So although no output VAT arises on such a supply, related input VAT is still recoverable. If it's outside the scope also, it will be recoverable. The input VAT will be recovered. That's why outside the scope is different from exempt supply. But they will not ask you the outside scope part in your exam. Mostly it is taxable supply and exempt supply that is asked. Now, moving on to the taxable supply divided into 3 categories. First category is zero rated. Remember they are taxable but the rate is 0. We'll see this in section 1.6 in detail. What are the zero rated supplies? Next is reduced rate supply. Reduced rate is 5%. But this is ignored in your exam, so you don't have to worry about it. Next is standard rated, where the rate is 20%. All the taxable supply, in fact, most of them are standard rated only. So standard rated here, you can recover your input VAT. Okay. Next. So the level of the taxable supply determines whether or not a person is required to register. What will help you to decide whether you have to register for VAT or not? It's your taxable supply. Okay. What are the exempt supplies? The following are exempt. Land and buildings with various exceptions. That means no VAT on them. Exempt means you don't charge VAT. Financial services, insurance, educational services, like provided by not-profit making bodies. Then health and welfare services provided by government. Supply of goods and services by charities. All these are exempt. So in your exam, you might be given exam supplies also along with taxable. You have to see to it that you are not incorrectly charging VAT on exam supply. Now, outside the scope. These are the outside the scope. Wages and dividends, transfer of goods arising from a business being sold. This was in section 2.6. Goods and services, section 5.4. Then export of services to all customers not within UK. This will see in section 6.2, the export part. So these are outside the scope of VAT. Next, zero rated. So these are the zero rated. Food. Okay. Food is zero rated. But remember, food that is there in the course of catering, hot takeaway food, confectionery, beverages, snacks, they all are standard rated. Now, sewerage service, zero rate. Books, newspaper, printed music, maps, zero. New and residential land and buildings, zero. Transfer of people by any vehicle for 10 or more passengers, zero. Travel services where travel destination is outside UK, zero. Air navigation, port, salvage, towage service, zero. Repair maintenance service of ship and aircraft, lifeboat and sea rescue service, drugs, medicines, aids for handicapped people, specific supplies of goods by to or by charity. Okay. Next, children's clothing and footwear, export of goods outside UK. And when that export of goods, there we have related transport cost also included in that. Then taxable person. A taxable person could be individual, could be a partnership, or could be a company that are making taxable supplies and are required to be registered for VAT. If a person is registered for VAT, okay, what happens? A person registration covers all of their business activity, however diverse it is. If you are registered, it will cover all your business. For example, if you are a partnership, it will be treated as a single entity if you are registered for VAT. Okay, the individual partners are ignored when you are registered for VAT. Okay. Now, next is registration and deregistration, the second part. Okay, so the first part was scope of VAT. We have finished it. Now, compulsory registration. When should you compulsorily register? If at the end of any month your taxable supply, mind you, taxable supply in the previous 12 months, it has to be 12 months, exceeds 90,000. It could be shorter period also, if it's shorter period also. Okay, so or shorter period, previous 12 months or shorter period, have exceeded 90,000. Historical test means you look back past, that's why historical test. Or at any time in the next 30 days you are expecting it to exit 90,000. Same. Historical test also 90,000. Future prospect test. Why future prospect test? You're looking in the future. Next 30 days. That's why. So here the taxable supply includes all your VAT exclusive. Okay. It includes your zero rated as well as standard rated supply. The 0% and 20%. Both are taxable. But excludes supplies of capital goods. If it's a supply of capital goods, it is excluded. For example, fixed or non-current asset. Because for them we have other rules. Now, so a person has to notify HMRC of the need to register within 30 days of the end of the month in which the turnover limit was exited, or by the end of the 30-day period during which the future prospect test will be satisfied. Now, some exam advice. So the current registration and deregistration limits are given in your exam, the 90,000, in case you forgot. Then effective date of registration is, if it's historical test, then from the first day of the second month after the limit is exited. That means one whole month will go, and from then the second month, the first day of the second month. If your limit is, let's say, exiting at the end of September, then the whole October will go, 1st of November will be the effective date. One day from second. Now, if it's future prospect, then from the date the ground first exists, that means the start of the 30-day period. However, even if registration would be required under either test, it will not proceed if HMRC is satisfied that the value of your taxable supply in 1 year, beginning with the proposed date of registration, will not exceed 88,000. That is the annual deregistration limit. See, under both your historical and future test, registration is required, but still you cannot register. Why? If your taxable supply will not exceed 88,000. Okay, in the 1 year beginning with the proposed date of registration, that means from the proposed date of registration, 1 year from that time, if you see your taxable supply is not exceeding 88,000, you don't have to register, even if you meet both the historical and future test, because that 88,000 is the annual deregistration limit. Now, moving on to activity 1, where you have to determine the latest date by when Mr. Tom is required to notify HMRC of the need to register for VAT and the date from which registration will be effective. So you have been given the sales. Okay. So for the rest of the year, sales remain at 2025 level. So here he has started operating 1st Jan 2024, selling books 0 rated and stationery standard rated. In the year end, that means for 12 months, sale of stationery 3,800 a month and sale of books 1,000 a month. And at the end of each month, taxable supply the previous 12 months did not exceed your VAT registration threshold of 90,000. Now, so during the first few months of the year ended 31st December 2025, they have given you the figure. So you have to see for the next year. In the previous year, they did not. 2024, by 31st December 2024, they did not exceed the 90,000 limit. So they did not register. Now you have to see 2024-25 limit to see whether you have to register or not, whether you have exceeded 90,000 or not. So let us see that. So now we will be calculating the taxable supply that includes both book and stationery. Okay, for each month. Now, so now if you see, stationery was 3,800, books was 1,000, together it's 4,800. Okay, if you take 4,800 into 12, it was 57,600. Did not exceed the VAT registration threshold. So now we will see the next year, 2025. So here it is 31st Jan 2025. Here it's Feb, 28 Feb. March. So we'll see in Jan. You see in Jan. The total is 9,200. With that you have to add. See, when they have given 9,200, we take the total. This is taxable turnover. So here when you are going to Jan, you are only taking 1 month of Jan, and previous you have to take at least 12 months, right? You should see the period should be always what, 12 months. Okay, many students get confused with this. Okay, so that means, for example, here it is Jan 2024 to December 2024. This is 12 months. Then we'll start from Feb 2024. So when it goes to Feb 2024, you have to keep on adding one more month, Jan 2025. Then if you start from March 2024, it would be Feb 2025. You see, always you have to keep on going 1 month ahead for 24, and then in 25 also you will keep on adding 1 month. If you see this from March to 24 to Feb 25, it's always 12 months. Here also is 12, here also is 12, here also is 12. That's how you do it. So in 31st Jan 2025, you will take from Feb 2024. So from Feb 2024, you have to take 11 months were there in that year. What was the total sale? 3,800 of stationery, 1,000 books, together 4,800. So 4,800. Okay. With this, you will add 1 month's sale of this year, that is given in this table, plus 9,200. This. So it is 62,000. That's how you do it. It's not 9,200 into 12. Then we will be going to Feb. So when you go here, now it will be 10 months. Here it would be 10 months into 4,800. With this you will be adding 9,200 of Jan and 11,600 of Feb. So here I will be putting a bracket because I want my multiplication to be done before my addition. The bottommost. Plus 9,200 plus 11,600. So now my taxable supply is 68,800. Okay, let me do the sum function. So it is still not exceeding. Okay, no need. It is still not exceeding 90,000. I will go to the next here. Let me put the bracket. So now it will be 9 months. 9 months of the previous year, that is 4,800. Plus I'll be adding the Jan 9,200, the Feb 11,600, and the March's figure 15,500. So it is 79,500. Still it did not exceed 90,000. Then we'll be moving on here to 30th April. So here we'll be taking 8 months into 4,800 plus the Jan figure 9,200 plus 11,600. The February's figure, March's figure is 15,500, and April 15,500 once again. So you see, this is the first time in April 2025 your taxable turnover is exceeding 90,000. That is the limit. So you don't have to go beyond this. You don't have to go beyond April. Now, when should you notify HMRC? Within 30 days of 30th April. 30 days of 30th April. 30 days means May 30. Okay. So 30th May. And registration will be effective from when? 1st June. Because they always say it is the second month, first day of the second month. So it is 30th May. You might say the next day is 31st May. No. They clearly the rule says second month, which is June. If you take from April, the second month is June only, and the first. So this is the effective date. Registration will be effective from this date, 1st June. And they have to register by 30th May 2025. So this is the answer for activity 1. As I told you, we have surplused 9,200 at 30th April 2025. So you have to register within 30 days from 30th April, that is by 30th May 2025. Registration will be effective second month, the first day, so from 1st June 2025. Okay. Now, moving on to activity 2. Here you have to determine the latest date by when Mr. Smart is required to notify HMRC of the need to register for VAT and the date from which the registration will be effective. Same as the previous question. Here, Mr. started a clothing manufacturer on 1st July 2024. In the first 3 months, taxable supply was 11,000 per month. On 3rd October 2024, he received an additional order for 80,000 of clothing for delivery by 31st October 2024. So now, let's see. You have to go by historical test and future. So here, Mr. Smart will be registered using the future test, as this will result in earlier registration than the historical test. We'll see. We'll put both the future and historical test and see. Okay? Because they told the latest date. Okay? So if you see, when is it exiting? If you take 80,000 with the monthly turnover, that is 11,000, it will be 99,000. So that is the first time it is exiting 90,000. Okay, that means the next 30 days itself, following 30th October 2024. Because you have received the order when 80,000 by 31st October 2024, right? So the next month, November, it will exit. 30 days following 30th October, you are expected to exit 90,000 under the future. So from October, the whole month of October, if you take, it's 3rd October. So from October, you will be taking 30 days. And October has 31 days, okay? So 30 days if you take, it will be 2nd November 2024. Okay? And if you are going by historical test, 30 days after the end of the month, when the turnover in last 12 months or fewer is greater than 90,000. Let's see note 2 for this. So turnover in the 4 months ending this one will be at least. So it will be, this is the first time. So if you see here, from July, August, September and October, 1st October. So the 4 months you are taking 11,000 and from there onwards is 80,000. So 4 months 31st October and then 80,000. So under historical test it will be 30 days from 31st October. That's why it's 30th November 2024. So the latest date is historical test. Now moving on to the effective registration date under both the test. So here if you go 2nd November, it is 30 days from there, 3 October. And if you go from 30th November, so it is the first day of the second month here. 30 days. If you go by future, it is 30 days. And if you go here, start of month following the end of the notification period, end of the month. Start of month following the end of, so end of the month is November, start of the month, next month is December, so 1st December 2024. If you go by historical test, this is how you calculate the registration date. End of the month, the next day of the end, from the end of the month. And if you go by future prospect test, it is 30 days. That's how you go. Add. Okay. So now, late registration. When you are registering late, there will be penalties. And we have covered this in lecture 11 also under income tax administration. When you register late, there are penalties. And penalties will range from 30 to 100% of the unpaid tax, that is output minus input, for the period between the date the person should have registered to the date of actual registration. Penalties will arise. But If you're making an unprompt disclosure, your penalties could be less. This we have covered in lecture 11. What is unprompted disclosure? How 30 to 100%? Because single penalty regime applies for all the type of taxes. If you are doing late registration, whether income tax, capital gain tax, corporation tax, inheritance tax, or VAT. That's why always refer to lecture 11. Full detail is given there for penalties and interest and all those things. Now, voluntary registration. Sometimes you might not have, you don't have to compulsory register. You're not exceeding the threshold, but you might voluntarily register for VAT. There are certain advantages of doing that. Okay, they are not satisfying the turnover test, no historical, no future, but they might voluntarily register for VAT. That is possible. Okay. Now, what are the advantages? It hides your small size of business. See, if you are registered for VAT, your business is taken as you're a big business. You get a lot of advantages also. It's easier to get loan, easier to get customer. Next, you can recover your input VAT also. If you are registered for VAT voluntarily, whatever the input VAT you have suffered, now you can recover them. But it is not possible if you are not registered for VAT. Okay. And also it is more advantageous if you are likely to recover more VAT than you pay. In that case, better to register voluntarily before you are meeting your threshold. Especially for those people who are making mainly zero rated supply. For them, input VAT is more than they can charge. So for that case, better to register voluntarily. Then it allows for you to claim input VAT on your pre-registration expenditure also. Before you register for VAT, whatever expenditure you've incurred, you can now claim. And it avoids penalty for future late registration. So these are the 4 advantages. Mostly under voluntary registration, if they ask you this, they will ask you the advantages. Why would someone want to voluntarily register if they are not meeting the threshold? So you have to know these advantages. Then there are some disadvantages also. First disadvantage is it is extra administration, charging VAT. Next, if customers are not VAT registered, for them it is going to be a higher price. They might turn away to competitor because your prices will then be higher because you are charging and VAT also in addition to your price. Okay. Next, exemption from registration. If you are making zero rated supplies, okay, mainly you are making zero rated supplies only, not standard rated, you might apply for exemptions from registration. What happens when you make an exemption from registration? You can save on your administration cost, but you lose your ability to reclaim the input VAT also. That's the disadvantage. On one hand you are gaining, other hand you are losing. Next, deregistration. Here you may voluntarily deregister if your taxable supply in the next 12 months will be 88,000 or less. Registration is cancelled from the date of your request. Okay, so a taxable supply who cease to make any taxable supply, they must compulsorily deregister. See, you might voluntarily deregister one thing. If your taxable supply in the next 12 months is 88,000 or less, you might compulsorily you have to deregister if you cease to make any taxable supply. No taxable supply. You have to notify HMRC within 30 days of doing so. If you are compulsorily deregistering, registration will be cancelled from the date of cessation. Now, so the VAT return for the final tax period ending with deregistration must include output VAT on all the assets of the business on which input relief was claimed and which are still owned at the close of the business on the last day of the registration. Output VAT on goods held at deregistration and taken for personal use must also be accounted for, but not if your tax liability is less than 1,000. Now, when you're transferring a business as a going concern, what happens? This is often asked, especially in ATX. When you're transferring a business as a going concern, what is the impact on VAT? So here, compulsorily deregistration applies when you're selling a business or you're transferring a business as a going concern to new owners. That means your business is running, but the owners are changed. Then you have to compulsorily deregister from VAT. But such transfers involve assets falling within the scope of VAT. However, provided certain conditions are met, this transaction will be treated as a supply outside your scope of VAT. Okay, so no output VAT applies to the asset that is transferred by the vendor, which in turn denies input recovery on the input. That means you are not charging an output VAT, you cannot recover input VAT also. Because this transaction, when you're transferring any asset to the vendor, it is outside the scope of VAT. The conditions are, if you're transferring your business as a going concern, your business is transferred as a going concern. Okay, there's no significant break in trading. There's the same type of trade is carried on before and after the transfer, and the new owner is registered for VAT. So where the new owner is not registered for VAT, then if the old owner and the new owner deregister and register for VAT simultaneously, the new owner can take over the old owner's VAT registration. Remember, if both are registered, new owner can take over the old owner's VAT registration. This procedure might not always be advantageous. Why? Because the new owner will inherit the VAT history of the former owner. For example, if they are late in paying their VAT, they are having VAT penalties or interest, then this will go on to the new owner also. Thus, the procedure is not compulsory. So this procedure is not compulsory, it is voluntary, whether you want to get the old owner's VAT registration or not. Next is group VAT registration, the third part. So under normal VAT rules, each limited company is separate taxable person. Making taxable supply in excess of 90,000 have to register for VAT. But if you are a group, you can apply for single registration that covers all the companies in the group. Okay, what is the definition of a group for VAT purpose? A VAT group has two or more companies established or having a fixed established in UK, common control by a single company, and an individuals in partnership for a business purpose. So it might be under common control by a single company or common control by an individual or individuals in partnerships. But it has to have the establishment in UK. Then only it's a VAT group company. Control means you are having more than 50%. Okay. Same way how we have taken the control defined as 51% group companies for corporation tax purpose. Remember, under corporation tax purpose we went through groups. That was my lecture 20. In my lecture 20 I've covered this. So more than 50%. So 51% group companies for corporation tax. Same control you have to apply for VAT. Now a VAT group can have both UK resident company and overseas resident company that operates in UK. Companies may either be taxable or exempt suppliers. It could be anything. Now, what is the effect of group registration? So when application for group registration has an immediate effect, although HMRC has 90 days in which to deny or modify the application. So one VAT return will be submitted for the whole group for each tax period. Then one company might act as a representative member of the group. It might not necessarily be the parent company, it could be anyone. Who is responsible? So that one company will be responsible for administrating VAT for the whole group. But the whole group remains liable for the group's VAT liability. What are the advantages of group registration? Number one, under normal VAT rules, okay, although the VAT is on transactions within the same legal entity, that falls outside the scope of VAT. VAT, say transactions between different companies would be liable to VAT. Now, but under group registration rules, the group is deemed to be one legal entity and intercompany transactions. So intercompany transactions are outside the scope of VAT. So group will account for VAT. That means only one sales and accusation. So the group need only account for VAT on external group sales and accusation. Anything among the group is outside the scope of VAT. But anything external to the group, if there is any sales, any acquisition that takes place, VAT will be accounted for it. So intergroup transfers are ignored from VAT. Number one advantage of group registration. Second advantage, although the registration should include all the group companies, but individual companies can be left out of the group registration if it would be disadvantageous to include them. For example, a zero rated supplier, okay, you can omit them. So they can be omitted to ensure that the monthly cash refund are received by that company, as opposed to having the recoverable offset against the output VAT from the rest of the group on a quarterly basis. So an exempt supplier can also be omitted. So it's better to leave out from the group the exempt supplier and the zero rated supplier. Ignore them from the group, omit them. Just put the standard rated supplier. Because if the zero rated supplier are omitted, they are going to receive the monthly cash refund, only that company. But if it's a group, it will be offset. Your output VAT will be offset against your input VAT of the whole group. Okay. Next, activity 3. So now we'll be doing activity 3 where we have sales of 3 companies and the purchases. Adam is owning 80% share capital of both Cox and Hale. Sales are all standard rated while Cox and Hale are zero rated. So you have been given. Now, the purchases of all the 3 companies, if you see, the purchases are all standard rated, but the sales of Cox and Hale are zero rated. So additionally, Adams incurred standard rated overhead expenditure of 300,000 that cannot be attributed to the sales of any of the 3 companies. Adam also charges its subsidiary companies a management charge of 40,000. Then all of the figures are exclusive of VAT. Exclusive of VAT, inclusive of VAT. These 2 terms you will often see in your exam. Exclusive means it does not include VAT, VAT is not included. Inclusive means VAT is included in that. Okay, so Adam and his 2 subsidiaries, they are not currently registered as a group for your VAT. Now, part A, assuming the group VAT does not apply. Calculate the VAT of each company and the VAT liability for year ended 31st December 2024. B, identify the conditions that must be met for Adam and his subsidiaries to register as a group for VAT and the consequences of being so registered. So let us do. So now let us do A. Okay. So we will be drawing the three columns for the 3 companies. A, C, and H. A is 20%, that means standard rated. C 0%. H also 0% because zero rated. So now, first we are going to record sales. Okay, so sales of A is 1.17. Done. C and H is 540 and 390. Next, we are going to have the management charge. Okay, so management charge will add So Adam charges each of his subsidiaries an annual management charge of 40,000. So apart from sales, the other income is management charge that Adam is receiving. 40,000 from each. There are 2 subsidiaries. So only Adam is receiving the management charge from his 2 subsidiaries. So 40 into 2, 80,000. Next, here both the subsidiaries are having zero charges. So now we are going to get our output. Here we are going to use the sum function. Done. Now I'm going to drag it to the other two cells. Okay. Now, so output VAT, I'm going to take 20% on output. That's why first you have to calculate output. Basically, it's all your income, like sales and management charge. So here is 20% on your output. But here, C and H are going to have 0 because their sales are 0 rated. But their purchases are all standard rated. Why it did not come? Because I did not put the equal sign. To perform a function, okay, a formula will only be copied when you are doing equal sign. Done. Okay, so it is 0. Now, what's next? Next is your purchases. Okay, so we are going to take our purchases now. This you will deduct from output VAT. But first you have to add all your inputs. Purchases, overhead, how many inputs are there? Management charge. See, management charge is an output for A, but because it is taken from C and H, for them it's an input. Okay. Done. So here 40,000, here 40,000. That's why they have got 80,000 as an output for A. Now, purchases. So here it's given 480, 270 and 150. Next, the overheads. See, overhead is 300,000, but it is incurred by A. So C and H will have 0 overheads. Now we will add all the input. Done. And I'm going to drag it to the other two columns. Now we are going to deduct input VAT at 20% for all the three because purchases are all standard rated. So 20% on the input, which we are going to take here. Now, what's next? Net liability. So here we are going to deduct from output VAT, we are going to deduct input VAT. And we are going to drag it to the other cell. In the first one, it's 94,000. Okay. Here, in this two, it's a recovery. You are going to get back. Why? Because it's negative figure. That means your output VAT is less than your input VAT. So now you can recover them. So what is the group's overall VAT? The group's overall VAT is sum function. So the group's overall VAT is 6,000. That means they are going to, there's a VAT recovery of 6,000. Now, let us go to part B. So this is the solution for activity 3, where we have got the total group VAT recovery, which is 6,000. Okay, so we have take the sum function of this, where we have taken the output VAT and deducted the input VAT. Output VAT is 20% only for A, C and H are 0, whereas input VAT is 20% for all the three companies. Okay. Now, moving on to part B, conditions to register as a group. Okay. So, first condition, one of them controlling each other. So, in this case, they are, because they have bought 80%. They have bought 80% in the two companies. And also, their place has to be in UK. The established place of business has to be in UK. And next, the consequences of group registration are each VAT group must appoint a representative member who will account for group's output and input VAT. All members are responsible for the liability to any tax due. Then, supply of goods and services by one member of the group to another member is outside the scope of VAT. Next, the other supplies of goods and services by or to a group member are treated as supplies by or to the representative member. So these are the consequences, these are the things that happens if you have registered as a group for VAT. Now, an application for group VAT registration must be made by any one of the company. Okay, and HMRC has a right either to deny or modify the application within next 90 days. That is 3 months. So now, recovery of input VAT. So let us go to the basic rule. Here, the basic rule which must be satisfied for input VAT to be recovered in respect of goods or services that you have acquired for resale, for example, inventory, or use in the business, let's say expenses, and non-current assets are, you have to have taxable. Okay, so the claimant must be a taxable trader supplier. Okay, which includes zero rated goods and services also, because zero rated are also taxable, even though it is taxed at 0%, right? Next, the input, you have to evidence it by a tax invoice, but there are some exceptions to this. Next, recovery is not specifically blocked. We'll see this in the next section, 4.2, why recovery might be blocked. And input is either purchased in the course of business in UK or import from a country outside the UK. So in this condition, you can recover your input VAT. Next, all input VAT on purchase of goods and services acquired by traders making exempt supplies is irrecoverable. If you are making exempt supply, you cannot recover your input VAT. Now, irrecoverable input VAT, what do you do with it? Here we say it's blocked. Okay, so input VAT on certain expenditure, you can never reclaim. So, these are the irrecoverable input VAT expenditure. First one, if you have withdrawn the goods and services from the business for non-business purpose, okay, so you cannot recover input VAT for it unless the output VAT is accounted for on the private use. If you have accounted for output VAT on the private use, then only you can recover input VAT. This we'll see in section 5. Otherwise, you can't. Next, new cars. And also with that new car, any extra equipment purchased with the car, you can't recover the input VAT. But unless the cars are either used for a car-based business like driving schools, car hire, for them it's their business only. For them they can recover VAT. But otherwise, any new car, if you are just purchasing, you can't recover the input VAT on that. Or you are using the car wholly for business purpose, like having a pool car used by employees for business only. Next, where a new car is leased and also used partly for private purpose. So 50% of the input VAT is irrecoverable. The other 50% is recoverable if your car is leased. Next, entertaining except of staff and overseas customer. If you're entertaining your staff and overseas customer, that is allowable. You can recover input VAT. But otherwise, entertaining is not recoverable. Then, disallow input VAT on your revenue expenditure ranks as a deductible expense for income and corporation tax purpose. Okay, and disallowed input VAT on capital items will qualify for capital allowance. For example, car with private use. Okay, so if you're having a car with some private use, capital allowances when you're giving will be available on the full VAT inclusive amount. It will not see whether there's a private use or not. Okay, now pre-registration expenditure. So here, this is before registration to VAT. If you have incurred any expenditure, you can recover the input VAT. In respect of goods, if you have acquired it not more than 4 years, that means it should not be more than 4 years before you register for VAT. Okay, so that good includes inventory as well as non-current assets. So not more than 4 years prior to registration and sold or used in the business after registration. Next, if it's a business service, then 6 months before registration, you can recover the input VAT. That's 6 months and 4 years, always remember. So now, example 2, pre-registration expenditure. So here they have registered for VAT with the effect from 1st October 2024. And these are the expenditures they have incurred. They have purchased one inventory, one machine, one legal fee, one stationery. And they have given the amount of VAT. So this is 10,000 plus VAT. This is 15,500 including VAT. You have to take the VAT out. This is VAT exclusive. This is VAT exclusive. Okay. And on 1st October, half of the inventory has already been sold. However, all of the stationery and office supplies were still unused and machines still owned and used in the business. So now we are going to claim the VAT input on our pre-registration VAT. You understand? So 1st October, if you see this, it falls within 4 years. So yes, you can reclaim. How much? You have claimed inventory 10,000 plus VAT, but you have sold 50%. So only 50% of 10,000 into the VAT 20%. So 1,000 VAT you can claim as an input VAT. Then we are moving on to machinery. Machinery also within 4 years 15,500 plus VAT. So because it is including VAT, you have to take the VAT out. This is how you take the VAT out. See, VAT is 20%, right? So in your 100, if you include 20, it's 120. That means 20 over 120. Not 20 divided by 100. It's 20 divided by 120. This is how you take the VAT out. So if you apply it into 15,500, this is the VAT. Okay, there was a price. To that price you have applied 20%, that is 2,583. You have added it and then you got 15,500. So you are working backwards now to find that VAT that was included there. The third one, legal fees. So this is regarding some employee advice on employee contract. It's a service. See, for goods you have to go 4 years back, but if it's a service, it has to be 6 months. 6 months before registration for VAT. But this is this date, 15 Feb. It's not 6 months from 1st October. It's more than 6 months. You see, March, April, May, June, July, August, September is more than 6 months. So you can't claim that. So it is 0. You have to write the reason also like this in your exam. More than 6 months before registration, so no VAT can be claimed because it's a service. Then stationery and office equipment, 300 plus 20% VAT. So 60. So all this you can claim. Pre-registration VAT. Moving on to the output VAT. So for output VAT, your place of supply matters a lot. Where is your place of supply? The general rule is, for goods, if it's a good, it is the country in which the trader making the supply is registered for VAT. If it's a service, the country where the customer is receiving the supply is registered for VAT. We'll see that to decide the place of supply. Then the rules Elements that are significant in deciding the tax treatment of export and imports we'll see in section 6. Export and import, okay? Now, what is the tax value of a supply? So the value of the supply is the sale price of the goods and service before VAT. But there are special rules for gift and items that are withdrawn from the business for personal use. This we'll see in the next two sections coming up. So the value of the supply is after deducting any trade discount. For example, for bulk purchases, you are getting some discount. Deduct that. That is your value of supply. Next, if you're having a cash discount. So where a cash discount is given for a prompt payment, VAT is based on the amount actually paid, remember. So this will vary according to whether or not the payment is made early or not. Because if you make early, you will qualify for the discount. So the supplier needs to either provide full details of the discount on the VAT invoice or provide a credit note after the discount has been taken. Now, let's see here where discount is given. So, there was an invoice that is issued 1000 plus VAT. Okay, a 2% discount is given if is offered for payment within 30 days. If the customer pays within this time. Okay, so what would be the VAT? 2% discount. So from this 1000, after discounting, will take 98% into 20. This is VAT. So VAT is 196. But otherwise, if you just take 20% on 1000, it would have been 200. If the customer pays within this time, that means if customer pays within 30 days, it's 196 the VAT. But if they pay after 30 days, VAT is 20% on 1000, which is 200. You see? So because of the discount, your VAT is reducing. Now, VAT fraction. For a standard rated goods, allow you to work out the VAT amount. That's what we have just done. 20 divided by 120. That means we are finding the price of goods before VAT, the VAT exclusive amount, from the price including the VAT. So VAT is 20% of the VAT exclusive amount. So if the standard good rated good is 100 and VAT is 20, so it would be 100 into 20%. And the VAT inclusive amount would be 120. If the VAT inclusive is given 120, VAT element is 20 divided by 120. So this is how, this is like you're grossing it up. 20 divided by 120 of 120, you will get the VAT amount. And sometimes this 20, 120 would be equal to 1/6 also. This pure maths. So we use 1/6 also can be used as a VAT fraction. It's the same. Okay. If you want to find the VAT exclusive amount, that means before the VAT, then it's 120 into 100 divided by 120 or 5 divided by 6. See, if your VAT is 1/6, VAT exclusive will be 5/6. Simple. Now, tax point. The time of your supply is the tax point, which is the date of supply. So this can either be your basic tax point or your actual tax point. It is used to decide in which return period a transaction falls and the rate of VAT is applicable. Now, so basic tax point is the legally correct tax point, and this applies like this. If your goods, okay, for supplies of goods generally, when the goods are dispatched to the customer, that is the time tax will be charged. That is known as tax point. If it is the supply of services, when your service is complete, that is the time VAT will be charged. And if it's goods that are supplied on sale or return, then earlier of when goods are adopted or 12 months after discharge. And goods supplied through vending machines when the machine is emptied. So remember this basic tax point. Now moving on to the next actual tax point. That is the invoice date or payment date if earlier. So this is used in the place of the basic tax point, provided if it either precedes or falls within 14 days after the relevant basic tax point. See, after your basic tax point, if it falls within the 14 days, then we use the actual tax point instead of the basic point. You understand? So the same rule applies to continuous supply. See, there are one that is you are supplying once, and there is another supply continuously keep on supplying it. Continuous supply. For example, rent every month you are paying. So for this, what would be the tax point? When are you taxing it? When the VAT will be charged on the rent. This will be your payment date if it's earlier, or the issue date of the invoice. So that is your actual tax point. Now, activity 4. So with activity 4, this is regarding a sale where we have to state the tax point and calculate how much output VAT should be accounted for in Mr. Tom's return for 3 months ended to 30th September. So during the quarter ended 30th September, Mr. Tom, this from activity 1, sold a bulk order of stationery 1000. VAT is not included. Customer paid a deposit of 100. VAT is not included. On 12th July, when he placed the order, stationery was collected on 1st September when he had issued it on 1st October. The remaining 900 was paid on 8th October. So what is the tax point? You see, here the actual tax point is the basic tax point unless the payment you have received is before your basic tax, or invoices issued before basic tax, or invoices issued within 14 days after the basic tax. So this is what goods or service. Always try to understand whether it's a good or service. You have to differentiate. It's very important in VAT. If it's good, the treatment is different. If it's service, the treatment is different. This is good. So that means when the goods are made available to customer. That is your basic tax point. So in Tom's case, when was it made available? Stationery was collected on 1st September 2025. He paid deposit 100 earlier, but it was collected on 1st September. So 1st September 2025 is the tax point. Now, that is there, basic tax point. Coming to the actual tax point. When did he pay? 100 deposit was paid on 12th July. And this is before your basic tax point. Your basic tax point is 1st September, but you are making 12th July. And the remaining 900, 1st September 2025. So the actual tax point for the remaining 900 is 1st September 2025. Why? Whichever is earlier. Since the invoice was issued more than 14 days later. That is the basic tax point. See, it was 8th October. And if you take from 1st September to 8th October, is more than 14 days. Basic tax point was 1st September. And your remaining 900 you have paid, that is your actual tax point, is more than 14 days later. So because it is more than 14 days, what is it? Your actual tax point will be equal to your basic tax point, that is for September only. Okay. So for the remaining 900, this is your actual tax point for September. But for the 100 deposit, your actual tax point is 12 July 2025. There are two tax points. One is for the first 100 deposit, the other one is for the remaining 900 deposit. And the reasons are given. So output VAT. So the total is 1000, right? 1000 into 20, which is 200. So this is regarding sales. So it's output VAT. So this output VAT will be accounted for in the quarter ended 30th September 2025 is therefore. So this is the output VAT. What is it? 200. Okay. Because they also told you to calculate what would be the output VAT. That is simply 20% into 1000. VAT will remain the same. The tax point only will differ. One is in July, one is in 1st September. Now, coming to gift of goods and services. So when you're making a gift, okay, and if it's made for non-business or personal reasons, the supply, okay, the supply is a taxable supply. Unless one of the following exceptions apply. That means taxable supply means you have to pay the output VAT, and input VAT you have to recover. That is the meaning of taxable supply. Now, if these exceptions are there, what happens? It's not a taxable supply. First, the gift is a business free sample. This is not a taxable supply if a gift is a business free sample. Next, the gift of goods and good and the value is small. The gift is of good. You are giving a good, not service. Good, value is small. Small means cost is not exceeding 50 per person, excluding VAT in a 12-month period. So all these exceptions are treated as outside the scope of VAT. If it's there, no VAT is charged if you are giving goods and services. First reason, if you are giving it as a free sample. Second, the amount is small, less than 50. Then those gift no output, no input VAT. But other than that, any goods and services if you are giving, it is taken as taxable supply only, where you are going to pay, okay, output VAT, and input VAT you are going to recover. Next, where goods and services are removed from the business for personal use and taxable supply arises, the tax value for output VAT are as follows. For good, it is the tax value is the cost of the replacement good, because you are removing something for your personal use. So the tax value will be the cost of the replacement good for goods, except if it's fuel for car. This we'll see in the next section. Then it's different. And for services, tax value is the cost of the service to the business. Now example 4, where we are having goods for private use. Preparing VAT return for quarter ended 31st March. These are the transactions. So gift of 50 free sample costing 5 each plus VAT. Next, gift of 40 diaries costing 15 each, including VAT. Gift of 10 leather bound personalized diaries for the best customer costing 55 plus VAT. Okay. Goods taken for private use by the owner costing 500 plus VAT, which would cost 570 plus VAT to replace. So now tell me regarding this three. What is it? See, regarding free sample, this is free sample and it is costing 5 only. It's outside the scope of VAT. Next, diaries. Even diaries, there is no output VAT on diaries because the cost is less than 50, and also on free sample. So no output VAT on free sample and the 40 diaries because the cost is less than 55 and 15. Coming to the leather it is 55. Yes, here output VAT will be charged because it has to be 50 per person, but it is 55. So now you have to what? Each cost 10 leather, each costing 55. So 10 into 55 into 20%. So this is the output VAT 110. This is due. Next, goods that you have taken for private use, 500 plus VAT, and to replace it is 570. So what would you take? Because it's good, VAT will be charged on the replacement, 570 plus VAT. So 570 into 20, 114 is the output VAT. Okay. Now, car expense and fuel for private use. If there is a business use of a car, full amount of input VAT you can recover. Now, where the road fuel is provided free of charge by the business for the private use of employees, then all input VAT you can recover. But the private use element is then normally accounted for by the way of an output VAT purposes in a scale charge for each tax period. Where you are having a private use, whatever is the scale charge, they will provide you in your exam. So this scale charge is based on your CO2 emission of the car and the length of the period, normally quarterly. The appropriate CO2 emission scale charge will be given to you in the exam. You don't have to worry how to calculate. Do not worry about the CO2 emission scale charge, it will be given to you. So this scale charge is assumed to be VAT inclusive. It has VAT in it, you have to take the VAT out. This is only for car expense and fuel. Now, the scale charge apply to sole trader, partners, employees or director. Can apply to companies as well as sole trader or partners. Now, if the full cost of your private use fuel is charged to an employee or director, the business can reclaim that input VAT. But output VAT on the charge to them. So the output VAT, how will you claim it? Based on the charge to the employee or the director, not the scale charge. If it's full cost. Input VAT, yes, you can reclaim. But if there is some business use, then full amount of input VAT you can claim. And other motor expenses are only permitted if for business purpose, so could require prorating. Remember, if it's for business purpose, yes, other motor expense also is permitted. Otherwise, you have to prorate between business purpose and personal purpose. Now, activity 5. So you need to calculate your VAT, could be payable or repayable for the quarter ended 31st December 2025. So now they have purchased some books worth 500, purchased stationery, this is including VAT, and other expenses is 846 including VAT. This all are standard rated. Included in your other expenses 300. This is respect of petrol. Sales remain at constant 3,200 per month. Stationery is 13,000 per month. Books are 0 rated. And so the appropriate quarterly VAT inclusive scale charge is to 423. They have given you. So now let us calculate. So you have to calculate output VAT first. Okay. So first you see it is 13,000 per month. How many months are there? It is for 3 months only. So 13,000 into 3 into 20% you have to take. That's what we have taken. Output VAT. And now private fuel. You have the scale charge is given, which is 423. So because you have taken, you want to take the VAT out, 1/6 or 20 over 120 on this. So this you will add. Next, input VAT. Because these are VAT inclusive, you have to. That's why it's into 1/6 into 1 divide by 6. So stationery. It is. You see, you have purchased stationery 10,340. And the expenses. Books are 0 rated, okay? So expenses is 846. All these are standard rated. But books are 0. So because books are 0 rated, they are neither charged by Mr. Tom on his sales nor to him by his suppliers on his accusation. Remember this. That's why books we did not include. So once we deduct the stationery and expenses, the input VAT from output, this is a positive figure. That means your output VAT is more than the input VAT. It's VAT payable. You have to pay this VAT. Coming to impairment losses. If a business makes credit sales, what happens? And it's not in the cash accounting scheme. We'll go through the accounting schemes, okay? In section 8. So if a business makes credit sales and VAT impairment losses are given in respect of an impairment cost. If debt has been written off in the accounts and at least 6 months has been elapsed since the later of the date of the supply and the due date for payment. So if this happens, you are going to get VAT impairment losses. Tax on the supply has been accounted for and paid. Now, next, section 6, VAT on exports and imports. So now when we are exporting goods and services outside UK, when it's a good exported from UK by a registered UK taxable supplier, okay, this is a 0 rated supply made in UK. Please understand, when you're exporting good from UK who is UK taxable supplier, then it's a 0 rated supply made in UK. These are the rules you need to understand when we are doing questions. And when it is services that are supplied to a VAT registered business, they are generally treated as being supplied in the country where the customer is situated. So no VAT is charged on the export of services outside the UK. Because if it's outside the UK, your place of supply also will be outside the UK, which is outside the scope of UK VAT. Because What did we told before? Place of supply for services will be the country where the customer receives the service. So if it's outside the UK, you are exporting your service. Customers will be receiving the service outside the UK, which is outside the scope of UK VAT. So your services mainly falls outside the scope of UK VAT. No VAT is charged. But if it's exporting of goods outside UK, in UK, how it will be treated? That you are making a zero rate supply. Now, so VAT registered exporters. If you are a VAT registered exporters, you can recover your UK import VAT. Now, so export we finished. Now we are moving to import. Import of goods and services outside UK. So first we'll go through the goods. If you have imported goods, on imported goods, output VAT will be charged. Okay, and this payment of VAT is immediate unless you are using postponed accounting. Postponed accounting means you are postponing, you're not paying now. Otherwise, immediately you pay the VAT. Postponed means the VAT paid is treated as a recoverable import VAT by the VAT registered importer. Now, exam advice. Postponed accounting does not have to be used. And there are some circumstances you cannot use it also. But however, as for your tax exam, it should be assumed that postponed accounting applies to all the imports of goods. Okay. Now, so a system of postponed accounting has been introduced so that VAT does not have to be paid at the time of importation. That means the moment you are importing, VAT is not charged. This is the meaning of postponed accounting. Instead, the input VAT is declared on the VAT return as output VAT. So it's input VAT, yes, but it will be declared as output VAT. And then you are reclaiming as input VAT on the same VAT return. This is known as reverse charge procedure. Input VAT you are showing as output VAT, and then on the same VAT return you are claiming input VAT also. This is known as reverse. Everything is reverse now. So this input VAT, remember this reverse charge procedure is for input, not export. Export is easier than import. Input VAT is accounted for on the VAT return covering the date the goods are imported. Therefore, for most businesses there is no VAT cost because the output VAT and corresponding input VAT are equal. So only time that there is a cost is if the business is making exempt supplies. Why? Because in exempt supplies you cannot reclaim your any input VAT. Yes, your input you will show as output, but you cannot reclaim any input VAT. There will be a cost. There will be a difference. So for most businesses there will be no output, no input VAT for importing of goods. But if you are making an exempt supply, yes, there will be a difference. Moving on to the third part, that is international services. When import of services from outside UK, now it's services. So as services supplied to a VAT registered business are generally treated as being supplied in the country where the customer is situated. So where a UK VAT registered business receives international service, the place of supply will be UK. This time services are imported to what? UK. So the place is UK. So in this case, what happens? The UK customer of the imported service will not be charged VAT by the overseas supplier. Okay, you as a UK customer, you will not be charged any VAT by the overseas supplier. So that means they are going to receive an invoice without any VAT. A UK customer who is registered for VAT must treat the service as if it was self-supplied. Remember, if you are receiving an import from outside UK, see, the outside people cannot charge UK VAT for the services that they are claiming. They can't charge output VAT because they are not UK. Yes, you are receiving it in UK, but UK VAT is for you, the one who is in UK, not for the outsiders, not for the overseas party who is supplying to you. So they can't charge a VAT on you. You understand? So that's why if you are import of services then it is treated as self-supply. That means you yourself is giving it the services to yourself. And so you account for output VAT based on the overseas supplier's invoiced amount. This is known as reverse charging. Again, it's reverse charging. Same for goods or services. If it's import, it's reverse charging. The reverse charge output VAT is then treated as import VAT. Whatever the reverse charge output VAT will be treated as import VAT in the same tax period. Same like goods. Now, so this reverse charging rule, what happens? What does it do? It prevents the overseas supplier from otherwise securing a competitive advantage over UK. What happens? See, if they are not charging VAT, what happens? In their country, they're going to get lots of customers because their goods will be cheaper than UK. Right? Because they are not charging any VAT. So for customers, if they are exporting, if the overseas people are exporting to outside, to UK especially, for them is cheaper. So other countries will get a competitive advantage over UK. But for UK, inside UK, if you are charging, then it's more expensive. So in order to make UK more competitive, this reverse charging is taking place. Okay. Company over UK VAT registers supplies by offering VAT-free services. Now, where reverse charging applies, the tax point is the earlier of invoiced date or the day the service is paid for. Now, activity 6. You have goods and services. A. It is exports. B. Import. So now here you have to explain the UK VAT treatment for the various trading activity for both A and B. So if it is export, this 100 is outside the scope of VAT, but this 150, it is export. What happens? We'll see. And if it's import, this and this reverse charge will apply. 120 and 160. So here, if it's export, remember export of service of 100. This is outside the scope of UK VAT. That means no UK VAT will be added to the invoiced amount. But if it's export of goods, it will be taken as zero rated supply in UK. So because it is zero rated means no UK VAT will be added to invoice amount. Same goods and services. Coming to the import. Import is more riskier. So here we will do postponed accounting. Under postponed accounting, the imports of goods will be treated as taxable supplies for UK tax. So here reverse postage. Input VAT will be taken as output VAT. Okay, and this so 20% of UK VAT. See, output VAT will be taken as input VAT is same, so there is no difference. Just take 20 and 120 and apply to it, which is 24,000. So this much of input VAT will be taken. Overall, there is no VAT effect, but this input VAT will be included. Now, if it's input of services, this also UK output VAT will be in the hands of the UK VAT registered customers. So here also reverse charging applies. 20% on 60, which is 12,000 UK VAT. So both output and input VAT is 12,000. That's why overall there is no VAT effect. Moving on to the general arrangements under VAT accounting. That means how it is administrated. Every person who is liable to be registered for VAT must complete a VAT return for every VAT tax period. Now, all VAT return you have to submit online. So following the introduction of making tax digital, most VAT registered business are now making tax digital software to directly submit their VAT returns to HMRC. So they must keep their digital record. Remember, this requirements will not apply to businesses whose turnover is less than the threshold, which is 90,000. but they might voluntarily register for VAT. VAT return you have to submit within 1 month and 7 days. This you have to remember for VAT. Always VAT return you have to submit within 1 month and 7 days of the end of the relevant VAT quarter to avoid any penalties. And VAT payable is due at the same time and must be paid electronically. VAT payable and VAT return same time you have to pay. Coming to the tax period, this is the interval of time, usually 3 months, in which both your output VAT will be charged and import VAT will be deducted. So the tax period, this can be varied sometimes by an individual application to HMRC so that you can make your tax period coincide with your business accounting year end. Now, traders may apply to use 12 monthly returns per year. So with each return due within 1 month of the end of each tax period, with an extra 7 days as long as paying electronically. So using of 1 month tax period, this is advantageous in terms of cash flow. Why? Especially for trader who is making zero rated supply, who would normally get paid refund rather than pay VAT. Okay. Now, what are the accounting records? So they must be generally digital, all your records and accounts, and it should be sufficient for you to enable you to complete an accurate VAT return. The account must contain a VAT account recording the amount payable or recoverable from HMRC for each tax period. And you should keep copies of all your sales and purchase invoices. And HMRC officials may visit a registered person from time to time to check the accuracy of their VAT record. This is known as control visit. And records and accounts must be retained for 6 years after the end of the VAT period. Failure to retain the records, penalty will be 3,000. This I've covered in lecture 11 also. It's the same for income tax also. Failure to retain the records, the penalty is always 3,000. It does not exceed 3,000. Now the tax invoices. So the tax invoices in the approved form must be issued to all customers who are registered taxable person. And your VAT invoices should usually be issued within 30 days of the date of supply or date of payment if earlier. Retailers need only issue a VAT invoice if the customer requests one. Okay. Input VAT you cannot reclaim without a valid tax invoice. So these are the details that has to be shown in a valid tax invoice. Invoice number, date of delivery, invoice date, name, address, VAT registration number of supplier, name and address of customer, suitable description of each type of goods or services supplied, quantity of goods or extent of the services supplied for each description, rate of VAT and the VAT exclusive value for each description, overall total VAT exclusive total, rate of any cash discount offered, and total amount of VAT due. See, in your exam, you will not be told to draw the tax invoice, but at least you should know what is included. Now, suppliers may issue less detailed tax invoice if their VAT inclusive value does not exceed 250. Less detailed means less than what we have shown in the previous slide. Then, items to be shown on a less detailed invoice are date of delivery, name, address, VAT registration number of supplier, suitable description of goods, services, rate of VAT, and total amount due. These are the 5 things. Now, credit notes. So where a taxable person allows a credit or a contingent discount to a customer, contingent means based on some condition that if you pay early, you are going to get a discount. Then there is no obligation on the person allowing the credit or discount to adjust the original VAT charge, provided that both supply and customer agree not to do so. However, if the original VAT charge, if you are changing it, this should be done by issuing a credit note. Usually you don't have to adjust the VAT charge. You don't have an obligation. whatever original value you have charged on the original amount before discount. But if you want to change the VAT charge, you have to issue it through a credit note. VAT returns. These are the following amounts that are typically recorded on VAT return. Output VAT, that is on sales. Remember, goods can include anything, inventory as well as non-current asset. And services, import of goods and services, taxable supply of goods and services, taken from business for personal use, you are going to charge output VAT on all this. Now, input VAT will be charged on goods and businesses service acquired in UK, goods and services imported in UK, goods and services taken for business for personal use, provided an output VAT was paid, and a relief for impairment loss. Then, so the difference between output VAT and input VAT will be the amount either you have to pay to HMRC if your output VAT is more, or you are going to get repaid by HMRC if your input VAT is more. In addition to disclosing the amount of output and input VAT, your VAT return should show the total of sales and purchases. Unless the annual accounting scheme is used, which we'll see later, the completed online return and related VAT amount is due 1 month and 7 days after the end of the VAT period. Now, errors. If the error in a tax period does not exceed the higher of 10,000 and 1% of your turnover, that is up to a limit of 50,000, what happens? The error will be regarded as immaterial and it will be corrected in your next VAT return. There will be no default interest, but penalties may be charged. If your error in the tax period exceeds the limit that we have just discussed, 10,000 and 1% of turnover, it's a material error. You have to separately notify HMRC. So there will be interest on it and also penalty. So the amount of penalty will vary according to the amount of tax understated, and this we have covered in lecture 11. Also, it is based on the taxpayer's behavior also, whether they have done it deliberately or it was a genuine mistake, things like that. Then, whether the refund of VAT arise from an error claim or otherwise, the claim can only relate to the overpayment of VAT made in the 4 years before making the claim for a refund. It will only apply 4 years back, not more than that, regarding overpayment of VAT in the 4 years. Now, when you are filing late, the penalty. So there are new penalties for late payment of VAT and late filing submission of VAT that has been introduced. Default charges were there, but now it is no longer asked. This was old system. Then, so now they are giving you a point-based system. Under this system, a business will incur a penalty point each time a quarterly VAT return is submitted late. If a penalty threshold of 4 points is reached, 200 penalties charged. Then, after that, if you're making late VAT return, another 200. Remember, after 2 years, your penalty points will expire. However, they do not expire once the penalty threshold has been reached. Then they will not expire. Once the penalty threshold has been reached, what happens? A business has to submit their VAT returns on time over a period of 12 months or 4 quarterly returns for their penalty points total to be reset to 0. That means for the next 12 months, after they have reached the penalty threshold, they have to keep on giving the VAT returns on time so that their penalty points that they have reached now is again comes back to 0. So example 5. Okay, it's about anti-limited submitting their VAT returns quarterly. They have reached the threshold 4. Okay, now on 1st October they already have 3 penalty points. That means 3 previous returns late, and they submitted their December return late and get a 4th penalty point. Because they have reached the penalty threshold, they will receive a 200 penalty. So the next quarter after December is March. This they have returned on time. So they stay at threshold 4, but they do not get a 200 penalty. 200 penalty will not be added any longer, but the threshold 4 that they have reached in December will stay same in March also. Then after March, the next quarter is June. Here they are again submitting late. What happens? Still they will be at the penalty point 4, but another 200 will be added this time. 200 penalty. You see? Now, late payment penalties, that is for late filing. Late payment penalties are different. This is considered different, and this is for each late payment. No penalty is charged if the VAT liability is paid within 15 days of the due date. 2% will be charged if it's paid within 16 and 30 days from the due date. Penalty will increase to 4% if it's paid more than 30 days from the due date. In addition, if your VAT liability is paid more than 30 days late, then there is a daily penalty at an annual rate of 4% that is being charged, beginning after the initial 30-day period, starting. Regardless of whether any late payment penalties are incurred, late payment interest will also be charged. You might incur late payment penalties or not, doesn't matter, but late payment interest will run from your due date until the date you have paid your VAT. It will keep on running. Then, so this late payment penalties are summarized like this. Up to 15 days late, none. 16 to 30 days late, 2%. More than 30 days late, 4%. And daily penalty. Up to 15 days late, no. 16 to 30 days, no. More than 30 days late, yes. And interest, yes, in all the three scenarios. Late payment interest. So late payment interest, this is aligned with the way interest is charged on your other taxes also. Income tax, capital gain tax, corporation tax, and inheritance tax. Reasonable excuse. Okay, so late payment and late submission penalties will not be charged if the business has a reasonable excuse of paying late or submitting late. For example, let's say you have to stay in hospital due to some reason. So this is taken as a reasonable excuse for paying late or submitting late. However, having insufficient fund, let's say you can't say that you don't have enough fund or you are too busy to complete your VAT return, that is not accepted as a reasonable excuse from HMRC. Example 6. So here 4 days late, 18 days late, 9 and 35. So now what happens? 4 days late, you will not have any penalty. So now we are going to go for each quarter. 30th September, 31st December, 31st March and 30th June. So if you see for the first one, this one, 4 days late, no penalty because it's within 15 days. But for late submission, 1 penalty point. In terms of amount, no, but in terms of point system, 1 point you will get. And late payment interest because 4 days. So out of 365, you have paid 4 days. The interest, see the interest is given, it will be given to in the exam. The official interest rate is 7.75 for late payment of tax. This is for any tax, interest, income tax, corporation tax. It is 7.75 into the amount which is given as 50,000. So 42 is your late payment interest. Moving to the next quarter, because you are paying late again, another penalty point will be added. So now your point is 2, and if you see, it is 18 days. So it's between 16 to 30 days. 2% penalty will be charged on your 49,000. So penalty will be charged 980. Now interest, how many days? 18 days late. So it's the same procedure, 187. Moving to the next 9 days, and you are getting a refund this time, 31st March. So because you are 9 days late, no late payment penalty. And also there's a due VAT repayment. It's not a payment, it's a VAT repayment. And because you are paying, there is another penalty. Now you are having 3 points. And because it's a repayment, no late payment interest. And the last quarter, 35 days, more than 30 days. So because it's more than 30 days, 4% interest on 38,000 late payment penalty. And now you have reached the fourth point. So because you have reached 4 penalty points, now 200 will be charged. With that late payment penalty, 1520. Now, because you are paying more than 30 days late, there will be a daily penalty for 5 days. From 35 to 30, the difference 5 days. So 5, and what is the percentage? 4% on 38, which is 21. And then late payment interest. How many days? 35 days you are late. 7.75 is the interest and on 38, so 282. Now moving on to payment by large businesses. If it's large businesses, how do you know it's large businesses? When your annual VAT liabilities is exceeding 2.3 million. So if this happens, you must accelerate your payment of quarterly VAT bills. Note that for large businesses operating under the payment on account regime, the due date for the balancing quarterly payments and the submission of return is the end of the first month in the next quarter. The additional 7 days, they are not available for these businesses, not available for large businesses. Such companies are required in respect of each tax period to make 2 additional equal electronic payments on account at the end of the second and the third month. This is for companies also, okay, under corporation tax. So this is how end of second and third month, 2 payments on account. That means the amount of payment will be 1 divided by 24 of your total VAT liability for the previous year. Then end of the first month in the next quarter, balancing payment. I'm sure you know what are the payment on account and balancing payment. This you should know from my previous lecture. I've covered it. So balancing payment is your outstanding amount for the tax period. So the installment payment scheme, this will commence with the first tax period beginning after any 12-month period where the VAT liability first exceed 2.3 million. From that time onwards, payment installment. A supplier can leave the scheme if the most recent annual VAT liability falls less than 1.8 million. But it's annual, okay? Now, we are moving on to the 3 schemes, VAT accounting schemes. First one is small business scheme. So these are for your small businesses. First one is annual accounting. So how do you join the scheme? The supplier must have reasonable grounds for believing that his taxable supply in the 12 months just beginning will not exceed 1.35 million. If your taxable supply in the 12th month will not exceed 1.35 million, you can join this annual accounting scheme. Okay. So business can join the scheme when registering for VAT or at any later date. However, if already registered for VAT, the trader must be up to date with their VAT returns and payment. Now, payment of VAT under this scheme. So you have to select an annual accounting period, which is usually your financial accounting period. You settle your VAT once because it's annual. Okay. So if you're under annual accounting, it's 9 monthly payment on account. How do you take that 9 monthly? 10% of VAT from your previous 12 month. And it will start at the end of 4th month of your current annual accounting period. Then a balancing payment of the remaining a balancing payment of the remaining sum will be 2 months after the end of your current annual accounting period. And then if annual accounting is used since first registration, The first year's payment on account are based on the estimated VAT liability for the first year, because you don't have any previous year to rely on. First time you are using it, you have to use an estimated figure. Next, when do you leave the scheme? You might voluntarily leave the scheme anytime. When your turnover is exceeding 1.6 million, you can leave the scheme. Advantages of the scheme is the cash flow. Okay, if your turnover is increasing, your current VAT installments are based on the lower figure. Why? Because it is based on your previous year's VAT liability. But if your turnover is increasing, it is not based on the current year. So in terms of cash flow, it's good. Next, you have to make smaller, more regular payments. Then avoid any uneven payment due to seasonal variation. Less administration. You have to complete one annual return only. Activity 7. Based on annual accounting, we have to calculate the VAT. So let's see. So he have registered for VAT 1st April. He applied for annual 1st April 24 and settled on accounting basis. So now you have to take for 2025, you have to use 2024 figure, 10% of 140. So already this is the net VAT liability, 21,000. So we are going to take 10% on 21, that is 2,100 each. Okay, 9 installments, so 9 into 2,100, which is 18,900. This is your payment on account. Your balancing payment would be so your net VAT liability is 25. You see 25. So go back and find the balancing figure. That is your balancing payment. This is easier. You see how easy annual accounting is. Now coming to the next scheme, cash accounting. Looking at the word, you know it operates based on cash. So this also can start any tax period, provided same like annual. You are expecting your taxable supply in the 12th month not to exceed 1.35 million, and if you have already registered, you have to be up to date with the VAT returns and payments, and you have not committed any VAT offenses in the previous 12 months. What are the requirements for this scheme? VAT is recorded as normal, but the supplier's cash book must satisfactorily show the VAT effect of the settlement of sales purchase expense. Output VAT is not payable until the customers have settled their invoices, which is good. And input VAT is not recoverable until the suppliers have been paid, because it's cash. Advantage is cash flow is improved if customers are late payers, because they're not going to run the risk of bad debt. So automatic relief is given for impairment losses. And this cash accounting, you can use it along with your annual accounting scheme. When you leave the scheme, you can voluntarily leave the scheme at the end of any tax period if you are not getting any benefit from the scheme. Okay. Next, you can also leave if your turnover is more than 1.6 million. Third, flat rate. Looking at the word flat rate scheme, you know there's a flat rate that is going to be applied. So conditions for joining the scheme: your expected VAT exclusive turnover will not exceed 150,000, and you have not committed any VAT offense. How does this scheme operate? For businesses with a low amount of input VAT, we see low amount of input VAT. Okay, we are going to apply a flat rate, that is 16.5%. This is applied to your VAT inclusive total turnover. Limited cost business means input of less than 2% of turnover. Okay, that means you have input which is less than 2% of your turnover, or less than 1,000 per year. Other businesses, they can apply a more beneficial fixed percentage rate of between 4 and 14.5 according to the type of trade the business conducts. Again, this rate will be applied to the VAT inclusive total amount. including zero rated and exempt supplies, instead of accounting for output VAT at 20% on each individual invoice. Here, flat rate, no relief is given for input VAT that you have suffered, but except for input VAT on certain capital asset purchases. Next, VAT invoices need only be issued to customers who are VAT registered. So the invoices will show VAT calculated at normal rate. This ensures customers remain indifferent to dealing with flat rate scheme as opposed to a non-flat rate scheme. Now, this scheme you can use in association with annual accounting scheme but not cash accounting scheme. Remember, cash and flat rate does not go together, but annual and flat rate goes together, cash and annual goes together. Now, some exam advice. The appropriate fixed rate will be given to you in the exam. Now, the advantages are, it eliminates the need to keep the detailed records of the purchases and sales. Okay. So, a record of flat rate scheme VAT calculation, flat rate turnover figure, and copies of VAT invoices issued only you have to record. You have to keep. Next, disadvantages. You cannot recover your input VAT. Especially if the businesses are having large input VAT that they have to recover, this is not advantageous for them to go for flat rate scheme. Next, it is not beneficial for businesses with turnovers that are zero rated or exempt supplies. Okay, because the flat rate scheme is good if you are having a low input. Because if this happens, then the flat rate scheme liability will exceed your VAT due, calculated on the individual invoice for the standard rated sales only. So when you leave the scheme, you may voluntarily leave the scheme anytime and you cannot rejoin for at least 12 months. This condition, rejoining in 12 months, was not there under annual and cash. And supply must leave the flat rate scheme if in the 12 months it is exceeding 230,000. Okay, the VAT inclusive turnover. And that VAT inclusive turnover will include the exempt supplies also. So that is within 12 months. 12 months is the last anniversary of the date of joining the scheme, or it is expected to exit 230 in the next 30 days. Now, example 7. So here they have an annual sales of 120, all are standard rated. Standard rated expenses are 8,400 inclusive of VAT. Flat rate is 12%. So on 120 we are going to take 20%. Because this is VAT inclusive, take the VAT out and deduct. So this is 22,600. Now, under the flat rate scheme, what would be the VAT liability? It would be 120, your sales, plus the output VAT, 24,000. So you're taking the output VAT and your sales, and you're taking 12% on that. This is your VAT liability. You see, your VAT liability is much lower than the normal routes. But input VAT you will not write there because you cannot recover input VAT. So that means on your output VAT, inclusive of VAT, that's why we have taken 24,000 VAT also with 120,000 sales, and then you apply the fixed rate, that is 12%. Now, VAT as in A above, except that 50,000 of sales are zero rated. Now what happens? So from 120, 50,000 goes, now you are left with only 70,000. Take 20, so now this is the VAT. So with 70, now you will add 14,000 plus you will add the zero rated 50,000 also, because that is the sales that are zero rated. On that you will apply 12%. So this time you see what happens. because now you are having zero rated. This time your VAT is less under the normal basis compared to the flat rate. So if you are having more of your zero rated sales, it's advisable to leave the flat rate scheme. So from the syllabus we have touched section F, that is VAT. We first went through the VAT registration requirement, when they have to register compulsorily and voluntarily. Compulsory when their registration threshold they have exceeded. For registering it is 90,000, for deregistering 88,000 or less. And when a pre-registration input VAT can be recovered, we have gone through the circumstances. 4 years for goods and for services, 6 months before registering. Then explaining the conditions that must be met for 2 or more companies to be treated as a group for VAT. Then we went through computation of VAT liabilities, where we have calculated VAT payable or recoverable. We understood the 3 VAT accounting schemes: cash accounting, flat rate scheme, and annual accounting, and also the administrative part, the penalty system, how it works, the late payment interest. Then we recognize the tax point when goods and services are supplied, the basic tax point and actual tax point. Then we went through the information that must be there on your VAT invoice. Also, principles regarding the valuation of supplies. We understood the principle recognizing zero rated and exempt supplies. We recognize the circumstances in which VAT is non-deductible. Then relief for impairment losses on trade debts. Understood the sale of business as a going concern. Then the penalties and the interest for late submission and late payment. The VAT treatment of imports and exports outside UK. And the postponed accounting for VAT on imports. The 3 schemes. You must know the advantages and disadvantages and how it operates. Cash accounting, annual accounting, and flat rate. So now let us go through the summary. VAT is a consumer expenditure, that is a tax that is collected at each stage of the business. And ultimately it is borne by the final consumer. It is charged on the taxable supply of goods and services in UK made by a taxable person. A taxable supply is any supply that is not exempt or outside the scope of VAT. So both standard rated and zero rated supplies are taxable supplies. Taxable supply standard rated 20, zero rated 0. Okay, and all input VAT relating to taxable supply are recoverable. Registration for VAT is compulsory if based on either historical or future test you are exceeding 90,000 turnover. And in that taxable supply, zero rated supplies are also included, but capital goods are excluded. Then a taxable person may register voluntarily without satisfying any of the test, as they can recover the input VAT. Next, when you're transferring the business as a going concern, this is outside the scope of VAT if certain conditions are met. Group of companies can apply for a single registration if they are under common ownership. That means one VAT return will go to HMRC for the whole group. And if you are an exempt or a zero rated supplier, you can be omitted from the group. Intra-group sales are ignored. Input VAT can be recovered on the purchase in the course of business in UK or imported from another country outside UK. Input VAT is not recoverable if you are making exempt supplies on new cars unless used wholly for business purpose, on goods and services for personal use or entertainment. Then there is a block input VAT, which you cannot, okay, they may be deducted as a trading expense, for example revenue expenditure, or if it's on capital goods, then as a capital allowance. Pre-registration input VAT is recoverable for goods if acquired 4 years before registration and 6 months if it's for services. Okay, 6 months before registration. Relief is given for impairment losses if trader has accounted for the output VAT on the sale. The debt is over 6 months and it has been written off in the creditor's account. Then you will get relief for impairment loss. Exported goods are zero rated. Exported services are outside the scope of VAT. VAT is recoverable on imported goods. So VAT return you have to submit online every 3 months. Monthly returns may be advantageous for repayment traders. And input VAT you cannot reclaim without a valid tax invoice. And this you have to issue to all your VAT registered customers. Retailers might only need issue an invoice at the customer's request. The single penalty regime applies to VAT. Default surcharges are no longer asked. New penalties are there for the late payment of VAT and the late filing. So the new late payment penalties range from 0 to 4% on the amount outstanding. This depends on the number of days that is late. Are you within less than 16 to 30 or more than 30 days? And the new late filing penalties are based on point-based system 1 to 4. So each quarter a business pays late, 1 point will be added, penalty point. Smaller businesses can account for VAT annually. Then the technical articles you have to read are the 2 parts on VAT. Thank you for watching, and I shall conclude all my lectures with this. Now I have finished all the 5 tax: income tax, capital gain tax, inheritance tax, corporation tax, and VAT. So now it's your duty to go and do the revision kit questions and past paper based on these 5 taxes.